Welcome back to Explain the Charts, your go-to source for in-depth market analysis. Today, September 21st, 2025, we're tackling the Australian dollar versus the US dollar, AUDUSD, a pair that has seen significant action lately. We'll be breaking down the crucial news affecting this pair and then diving into the raw chart data across multiple timeframes to give you a complete picture. Let's start with the news that's driving much of the current sentiment. The most impactful development is the U.S. Federal Reserve's recent hawkish tone, indicating a slower pace for its rate-cutting cycle for 2025. Instead of 4 projected cuts, they now anticipate only 2, signaling a higher-for-longer dynamic. This surprise hawkish tone directly caused the Australian dollar to crash, sending it to a 24-month low as the US dollar significantly strengthened. Adding to the AUD's woes, Australia's labor market unexpectedly weakened in August, with a decline in full-time jobs and reduced participation, which is a significant bearish indicator. We've seen reports, even in the last few days, that AUDUSD has been slipping lower as the US dollar continues its recovery, testing a major support level at 0.6600. Conversely, some reports from a few days prior had hinted at a bullish bias, but the Fed's recent stance appears to have overshadowed that. Now, let's look at how these fundamental shifts are reflected in the daily chart. Looking at the broader trend from May 2024 to the present, we can see a clear overall downtrend for AUDUSD. Notice the sharp declines, particularly around late July and early August 2024, when the pair dropped significantly from the 0.67 range to around 0.64. A particularly large bearish candle on April 4, 2025, saw the pair plunge by 4.5%, reaching lows around 0.5985, which is a key historical low. This strong bearish momentum aligns with the news that the Aussie dollar crashed to a 24-month low, potentially correlating with earlier hawkish signals or a build-up to the recent Fed statement. While there have been bounces, such as the one in mid-April 2025 from near 0.59 to above 0.63, these have largely been contained below previous resistance levels. The level around 0.623, mentioned as a 24-month low in the news, is indeed a critical historical support that was tested multiple times in late 2024 and early 2025. However, there is an outlier candle on December 25, 2024, with an extreme low of 0.54287, which may indicate erroneous data or a flash crash and should be viewed with caution. Currently, the price is consolidating but has been trending downwards in the past few weeks from highs near 0.655 earlier in September. Switching to the 1-hour chart, covering the period from September 1st to September 4th, 2025, gives us a closer look at intraweek dynamics. Here, we observe the pair trading in a relatively tight range around the 0.654 to 0.655 mark at the start of September. A notable bearish move occurred on September 2nd at 7 o'clock Universal Time Coordinated, where the price saw a sharp hourly drop from 0.65427 to 0.65042. This dip suggests an early sign of the US dollar's recovery gaining traction, even before the most recent news of major declines. Following this, the pair attempted to recover, but then consolidated, fluctuating without establishing a strong directional bias during this early September period. This relatively older data does not fully capture the bullish bias mentioned in news from 5 days ago, highlighting how quickly market sentiment can shift with new information. However, it does show the initial fragility of the AUD against strengthening USD pressures. Let's zoom in further to the 15-minute chart for the most recent trading action, from September 16th to September 19th, 2025. This time frame perfectly illustrates the current bearish sentiment driven by the recent news. On September 17th, around 1831 Universal Time Coordinated, we saw a significant bearish candle, marking a sharp drop from 0.66889 to 0.66526. This rapid decline aligns precisely with the news that AUDUSD has been slipping lower as the US dollar continues its recovery. Throughout September 18th and 19th, the pair largely remained in a downtrend, consistently putting pressure on the crucial 0.6600 level. We can clearly see that the price closed on September 19th at 0.65854, decisively breaking below the 0.6600 psychological and technical support level that was prominently discussed in recent reports. This breakdown confirms the bearish momentum and the dollar's strength, pushing AUDUSD into lower territory. Connecting the news to the charts, the Fed's higher-for-longer stance directly bolsters the US dollar, putting sustained pressure on riskier assets like the Australian dollar. The weaker Australian labour market data further diminishes the AUD's appeal, contributing to the bearish outlook. The recent break below the 0.6600 support, visible on the 15-minute chart, is a direct manifestation of this fundamental pressure. For traders, this suggests a strong bearish continuation in the short term, with attention now turning to the next potential support zones. Long term, if the Fed maintains its hawkish stance and U.S. economic data remains robust, while Australian data disappoints, we could see further depreciation for AUDUSD. The market's reaction to President-elect Donald Trump's potential low-tax, higher tariff environment is also a significant long-term factor, as it could fuel inflation and keep the Fed cautious on rate cuts. Let's recap the important price levels and potential scenarios. Immediate short-term support lies around the current price of 0.6585, with further key levels at 0.655 and 0.652. A break below these could see the pair quickly target the 0.650 psychological level and eventually retest the significant 24-month low around 0.623. For resistance, the immediate level to watch is the recently broken 0.6600 mark. A strong pushback above this would be a bullish signal, though it appears less likely in the immediate term, with only about a 30% chance given current sentiment. Further resistance exists at 0.665 and the multi-month high of 0.67. Reasons to be bearish are reinforced by continued Fed hawkishness, strong U.S. job reports, and weak Australian economic data. The likelihood of further downside is high, probably around 70 to 80% in the short term, especially if 0.6585 fails to hold. A bullish reversal, with a 20 to 30% likelihood, would require a significant shift in the U.S. Federal Reserve's tone, a stall in the U.S. dollar's recovery, or surprisingly positive news from the Reserve Bank of Australia. Traders should monitor U.S. inflation data, Fed statements, and Australian employment figures closely, as these will be critical catalysts for future price action. Also keep an eye on market risk appetite, as any major global events could quickly influence this pair. Always remember to manage your risk and consider multiple factors before making any trading decisions.